All right. Good morning, everyone. It's great to see all of you today. My name is Greg Dacko. I'm the chief economist at EY. And today I have the honor and the pleasure of moderating a session on the economy and monetary policy with President Evans. President Evans is someone that needs no real introduction. He's a longtime friend of NABE, but I'll still run through a quick bio. So President Evans has been president of the Federal Reserve Bank of Chicago since 2007. In that role, he serves on the Federal Open Market Committee. Prior to that role, he was senior vice president and director of research at the bank. And he's very active in the civic community and serves on multiple boards. President Evans obtained his bachelor's degree from the University of Virginia and his PhD from Carnegie Mellon in Pittsburgh. So without further ado, President Evans, the floor is yours.
Thanks, Greg. Thanks, Dave. Welcome to Chicago. It's really great to have you here. It's a city worth visiting many, many times, so please come back. Let's see. I'd like to add my congratulations early on to Ben Bernanke, Doug Diamond, and Phil Dybvig for being awarded the Nobel Prize in Economics for their contributions to studying banking crisis, financial crisis, and really doing a lot of great theory work. So it's extremely well deserved. Other light touch, I was talking to somebody beforehand and they asked if there would be something helpful in my speech or perhaps newsworthy. I'm extremely confident that there are 2 paragraphs somewhere in this speech and it's your job to find out which ones. The last time I spoke at a NABE event was in September 2021, in person in DC. At that time, we had only begun to see some broadening of inflation beyond items most directly affected by pandemic-related relative price swings. Most forecasters, including myself, and many of you in this room, thought the momentum wouldn't be sustained and were forecasting inflation to return near the Fed's 2% target by the end of 2022. It's nice how we swept other people into our own judgments, isn't it? Well, the economic landscape looks different now. In the US and elsewhere around the world, what began as narrowly concentrated shocks to relative prices has spread, turning into broad-based increases in overall inflation to levels far above every central bank's target. Accordingly, monetary policymakers now are significantly tightening policy in order to bring inflation back in line with their price stability mandates. Since March 2022, the Federal Open Market Committee has increased the federal funds rate, our main policy tool, by 3 percentage points. We also are reducing the size of our balance sheet at a relatively rapid clip. The Federal Reserve is committed to returning inflation to its 2% average goal. To do so, I expect we will need to raise rates further and then to hold that stance for a while. Of course, the exact path forward for policy will depend on the evolution of the economy and risks to the outlook. My talk today will describe my thinking beyond this path in more detail, as well as why I think we can bring inflation down relatively quickly while also avoiding a recession. And before I begin, these are my own comments and not any of those of my Federal Reserve colleagues. This audience is certainly familiar with the current situation, so I won't spend too much time discussing the incoming data, which, as you know, have been mixed. Household and business spending have been moderating. Lower real disposable income and a policy-induced tightening in financial conditions are clearly in play. This is most notable in the interest rate sensitive housing markets, where mortgage rates have about doubled since the beginning of the year. In contrast, the labor market remains strong, with robust job growth, elevated job openings and quits, and an unemployment rate that's at the very low level we experienced before the COVID crisis. However, over the past few months, we've heard more reports from our business and community contacts of reduced job turnover and that some are finding it easier to attract qualified workers. These are signs that some of the unusual strength in labor demand may be waning. Increasing pay and more flexible work arrangements may be part of the explanation, as well as the softer growth in spending. As of yet, these anecdotal reports haven't shown through strongly in the aggregate data, although job growth has moderated some from its extremely rapid pace, and last week's JOLTS report contained a notable drop in vacancies. On the labor supply side, while many workers who left the labor force during the pandemic have re-entered the labor market, many others have not. And today, labor force participation is still well below its pre-pandemic rate. Most of this shortfall is accounted for by older workers, as the pandemic apparently accelerated the retirement decision for many baby boomers who would have eventually exited the labor force anyway. Another factor weighing on labor supply is the quite low inflow to the US labor force from immigration. A strong labor market may still help draw some of those sitting on the sidelines back into the workforce and alleviate some labor market pressure. When I spoke here last year, I expected the labor supply response to be fairly large. But as time passes, I become less optimistic that this channel will provide much relief from labor market pressures. Indeed, the labor force participation rate currently does not appear far from its long-term trend. This brings me to a discussion of what is the principal issue facing the economy in the United States and elsewhere around the world: inflation. After more than a decade of missing our average 2% target to the downside, PCE inflation has risen quite quickly from under 1% in mid-2020 to 6.2% in the most recent August data. Excluding food and energy, core PCE prices rose 4.9% over the past 12 months. Reducing inflation to a level consistent with the Fed's 2% objective will require a period of restrictive financial conditions to restore better balance between supply and demand economy-wide. This will generate below-trend growth and some softening of labor market conditions. But ensuring low and stable inflation is a prerequisite for achieving the sustained strong labor market outcomes that bring benefits to everyone in our society. These broad contours are demonstrated in the FOMC's latest summary of economic projections, which this audience is undoubtedly familiar with since it's a top 10 publication, top five. The SEP dot plot shows that most FOMC participants are looking at something like another 100 to 125 basis points of rate increases this calendar year, with the median projection for the federal funds rate then rising a bit further to 4.6% at the end of next year. This monetary restraint is clearly showing through in the projection for GDP growth, which the median participant sees running somewhat below its long-run rate over the next year and a half or so before moving back up to trend later in the projection period. The unemployment rate is projected to rise to 4.4% by late next year and then remain near that level in 2024 and 2025. While this does represent a noticeably softer labor market when compared with today's, these certainly are not recession-like numbers. As for inflation, with supply-side improvements, restricted monetary policy, and below-trend growth, inflation is expected to moderate significantly. According to the median SEP, total PCE inflation is expected to fall to 2.8% in 2023 and eventually return to our 2% target by the end of 2025. I should note that my personal forecast is broadly in line with the median SEP. This is also true for many outside forecasters, as we see in the NABE Outlook survey that was released this morning. I guess maybe the NABE median dots are lower this year and next than mine. Now, in sum, the consensus baseline is projecting a large decline in inflation over the next year and a half, but with only a modest increase in the unemployment rate. That would be a pretty good looking soft landing. Now, we all recognize the substantial uncertainty surrounding the outlook today. What about this baseline? What rationale can get us there? I can't speak for others, but let me walk you through some of my thinking. And remember, this is a modal forecast, and other less rosy alternatives have a reasonable likelihood of occurring. I'll begin with some familiar observations about the role that relative price adjustments and supply chain problems played in the rapid increase in prices. The pandemic induced a shift in household spending from services, such as travel or dining out, towards goods, such as appliances for home improvement projects or consumer electronics. Many goods-producing businesses struggled to keep pace with this strong demand. particularly as they face COVID-related disruptions in production and supply chains. Labor shortages due to a broad-based drop in labor force participation were part of the story too. Inflation began to pick up in early 2021 as prices rose sharply for goods that are especially sensitive to supply chain problems and for services that were just beginning to reopen from the pandemic shutdowns. It has taken us time to get there, but today there are a number of signs that supply chain difficulties are improving. Ports are less congested, freight costs are falling, and supplier delivery times are improving. And with the pandemic bounce back behind us, some heat is coming off items such as airfares and hotel prices. But all is not well yet. For example, for quite a while, a shortage of microprocessors held back the production of motor vehicles. Now the chip shortage seems to be largely resolved, but shortages of other parts are now reportedly limiting assemblies. In turn, the problems at part suppliers appear related to difficulties they are still having in staffing production lines. I'm sure we've all heard many other anecdotes that highlight this interaction between labor market tightness and supply chain issues. Save this idea, I'll come back to it in a moment. Looking ahead, supply chain repair will continue and consumption patterns will normalize. And we may also see some further recovery in labor force participation, though as I mentioned, I think the prospects for this are limited. Admittedly, these adjustments have taken much longer than I had expected, and disruptions from the Russian invasion of Ukraine and unpredictable COVID-related shutdowns, notably in China, haven't helped. But progress has been made and more is coming. And the reduced price pressures from these supply side adjustments are an important factor in my forecast for declining inflation. However, over the past year or so, we've seen a lot more inflation than can be explained by changes in relative prices. We've experienced a broad-based increase in inflationary pressures that monetary policy must address. Without a period of restrictive policy, inflation will come down some, but not to anything near our 2% objective. The required monetary response will restrain aggregate demand. An important question then is, how much will this restraint weigh on the employment lag of our dual mandate? Obviously, the pandemic era shocks have wreaked havoc on the usual relationships between economic variables and on the models we use to explain them. This has been particularly true in the labor market. Here, though, the unfamiliar patterns point to reasons why our inflation forecast may be achieved with only moderate adverse increases in unemployment. For example, there's the configuration of the beverage curve, where we have seen a marked increase in the vacancy rate observed for any given unemployment rate. It's possible that as labor demand subsides, we could see a large decline in vacancies and reduce pressure on wages and inflation without a corresponding large increase in the unemployment rate. Indeed, the drop in the ratio of vacancies to unemployment in the August JOLTS report is good news for this hypothesis. Now, there's a good deal of debate over this topic, and I don't want to wade into it here. Indeed, I have a confession. I've always been more comfortable viewing labor market dynamics and inflation through the lens of the Phillips curve. Call me a hopeless romantic. Anyway, here too, I see unusual behavior that suggests we can disinflate without a large increase in unemployment if we navigate the path to a reasonably restrictive policy setting carefully and judiciously. The rapid increase in inflation we've experienced can be explained by a temporary steepening in the Phillips curve. Conceptually, this steeper than usual Phillips curve is due to the unusual interactions between labor market tightness and supply chain problems that I noted earlier, namely the lack of materials and parts arising from shortages of labor at upstream suppliers. This phenomenon appears to be fairly widespread. Because of this additional supply chain channel at recent unemployment rates, labor market stress is having a larger effect on inflation than would typically be the case. These extra supply chain interactions were not an issue when the unemployment rate was around the same low level in 2019. And so we saw less of an inflationary impact from labor markets, tight labor markets back then. If this steeper than usual Phillips curve is generating much of the higher inflation we're now seeing, then we should also expect this steeper curve to help bring inflation down relatively quickly with only moderate increases in the unemployment rate. Steep on the way up should be steep on the way down. Furthermore, I have in mind a non-accelerationist Phillips curve in which inflation expectations are not a mechanical function of recent inflation. Today, longer-term inflation expectations are anchored near our target and so provide an important downward force on actual inflation. So my baseline forecast sees the combination of further supply repair, a steeper Phillips curve, and anchored long-run inflation expectations, moving inflation back to target without having to generate an inordinate amount of slack in the economy. This mechanism does, however, require reducing the heat in labor and product markets, as well as maintaining a downward pull from inflation expectations. This is where tighter monetary policy comes into play. I see the nominal funds rate rising to a bit above 4.5% early next year, and then remaining at this level for some time while we assess how our policy adjustments are affecting the economy. When you factor in inflation expectations and the reductions in our balance sheet, we'll be at something equivalent to nearly a 2% real funds rate at this time. This is a fair amount of restriction when compared with the 1/4 to 1/2% long-run real neutral federal funds rate that's implied in the SEP. But I feel it's needed to facilitate market adjustments by bringing aggregate demand into better balance with aggregate supply and to ensure that long-run inflation expectations remain in check. Our rapid pace of rate increases has fast-tracked our arrival to such a restrictive stance. Front-loading was a good thing, given how far below normal neutral rates were. But overshooting is costly too, and there's great uncertainty about how restrictive policy must actually become. This puts a premium on the strategy of getting to a place and level where policy can plan to rest and evaluate data and developments. Now, there are many risks that could derail this optimistic forecast, and unfortunately, many of those risks appear to be to the downside. Supply side repair could continue to move too slowly. Events in Ukraine or further COVID-related shutdowns could put additional pressure on costs, and monetary policy may, on the one hand, not rein inflation in enough, or on the other hand, weigh too heavily on employment. Another risk is that inflation expectations could become unanchored. Inflation will be much more difficult to rein in if households and businesses start thinking outsized increases in wages and prices are the new norm and incorporate those expectations into their decision-making. But the good news is that in general, measures of longer horizon inflation expectations have remained within a range that's consistent with our 2% inflation objective. These perceptions can change and aren't something we can take for granted. I believe the Federal Reserve's strong policy actions and communications have played an important role in anchoring long-run inflation expectations by demonstrating and conveying our commitment to bring inflation back into line with our 2% inflation objective. The public and markets appear to believe we will be successful, but it's up to us to follow through and do our job. Now, policy communication has many aspects to it. I admit we don't always get it perfect, and we certainly hear from you when we don't. Then again, sometimes we receive criticisms about what I see as useful communications. In particular, I know some are uncomfortable with the idea that the Fed provides projections for policy rates in the summary of economic projections, knowing that we will certainly see a different path for rates if economic conditions or risks turn out otherwise. Some even say this is a good reason not to provide such projections at all. If you can't tell me the number for sure, why tell me anything? I strongly disagree with this view. Monetary policy is clearly influencing our projections, so what's the downside of revealing how we view this role in doing so? I know we have had elevated financial market volatility at times over this rate cycle. These are uncertain times, and no communications can reduce underlying fundamental economic uncertainty. But think how much additional uncertainty and costly volatility we would have unnecessarily generated over the past year if we had not augmented our policy moves with guidance about our plans for the ultimate level of the federal funds rate and its expected influence on economic outcomes. Indeed, even though rate hikes didn't begin until March, The information in the SCPs and other Fed communications likely assisted in substantially tightening financial conditions by mid-year, and did so without the large dislocations in financial flows that have at times accompanied past changes in the trajectory of policy. And given how quickly financial conditions reacted to our policy communications, perhaps we have shortened one leg of the long and variable lags of the monetary transmission mechanism. This seems like a good development. So to conclude, I realize I may have come off this morning sounding rather optimistic. I don't want to diminish the task in front of us or downplay the difficulties some may experience under the less favorable labor market conditions envisioned by my baseline outlook. And there's a real risk of seeing heavier costs with a larger than expected drop in employment. These are things we must be mindful of. No matter the circumstances, the FOMC will always set policy with the goal of progressing toward both our dual mandate objectives of maximum inclusive employment and price stability as expeditiously as possible. Today, though, inflation is our primary concern. Reducing it will likely require a sustained period of restricted monetary policy, below trend growth, and some softening of labor market conditions. But this is necessary to restore inflation to our 2% target. We hope to achieve this goal as quickly and efficiently as possible, leading to a period of sustained price stability and strong labor market outcomes under which all can prosper. Thank you very much.
Thank you very much, President Evans. And for the audience, if you have questions, you can submit them and I'll receive them on the iPad here. So I wanted to kick it off by asking a question relative to the Phillips curve. You mentioned that if it's steeper on the way up, it's steeper on the way down. In the context of the most recent data that we received on Friday with job growth moderating, but labor force participation actually falling back, how do you consider essentially the state of the economy right now? Has your perception of the state of the economy changed? And do you believe that the labor market tightness has also changed?
You know, I know that, I mean, certainly measured by the, you know, the broad indicators, the unemployment rate, you know, is low at 3.5%. And, you know, it hasn't been, you know, that long ago that when I talked to a number of people, they kind of thought 3.5% inflation. Aren't you worried about inflation? This is years ago. Wouldn't you be worried if we got that low? That's standard mainstream reaction. We've actually navigated strong employment and labor markets quite well. As I mentioned, in 2019, we experienced unemployment at these lower levels and not the same inflation that we're seeing here. So currently, our biggest challenge is inflation. It's certainly been initiated and had strong drivers coming from supply chain, supply side problems. And so the labor market being strong, I find a good thing. There are many businesses, manufacturers in, you know, areas which are not centralized outside of, you know, larger metropolitan areas and small markets, exurbs and suburbs and rural areas. Business models that worked before are being challenged because of this, in my opinion, this long trend in you know, lower labor force participation, which is really hitting hard, you know, right now. So fundamentally strong labor market is going to be important for improving the supply chain. We just need to get the balance there so that demand is in line with the supply that we're able to achieve now.
I mean, we're hearing a lot of similar stories from a lot of the business executives that we talk to at EY. We conduct regular CEO and CFO surveys, and one of the dominating themes that seems to come out is this idea that the value of talent has shifted post-pandemic. That talent is much more valuable, and therefore business executives are really keen on retaining that talent and not laying it off as in the past. In the surveys we conduct, there are very few business executives that talk about, you know, broad-based layoffs or even broad-based hiring freezes. Everything is very strategic. The Fed's economic projections, the summary of economic projections, show that you have an unemployment rate around 4.4% by the end of next year, which would, in a sense, be similar to recession. What do you perceive as being the risks around that forecast for 4.4%?
Well, I think your comment about the importance of talent is really interesting. You know, in one way, we know that talent's always been important, and so you kind of go, why all of a sudden is talent important? Has something changed dramatically about the economy and technology? Well, that's undoubtedly true, given our emphasis on you know, digital means and all of that. I think much of this has been knowable for a long period of time. It's just that the current circumstances, businesses, I think, are crystallized in their idea that they need this, and there's really a lot of competition for that talent. So I think that's part of it, the scramble to sort of gather the appropriate talent that maybe they should have gathered years ago, but now they can really see the losses ahead of them if they don't. So I think that's an important part of this. We're getting to points in our economic development where I find it difficult to think about simply aggregates, the aggregate labor market, the aggregate unemployment rate. I think that there's so much dispersion, the need for talent, the fact that lower income, lower skilled workers have received stronger wage gains recently, I think is a good thing. Remember, we've seen tremendous increases in income inequality over a long march for a period of time, and that fundamentally has to have implications for how the economy performs, it seems. But in our current state of how we think about aggregate economics, we focus on averages a lot, and averages sort of miss things that medians do more. So I think businesses are responding to this. They're finding it more and more in their own enterprises, and they're forced to make challenges. Ultimately, I think that's good, because I think these were inevitable. But the transition on top of everything that we're facing with supply side challenges makes it a particularly interesting period, certainly for everyone in your business.
Yeah, absolutely. It's a fun time trying to forecast in this environment. But from a labor market tightness standpoint, you mentioned the JOLTS report that we recently got, which was encouraging because it showed a fallback in the jobs openings rate without a significant increase in the unemployment rate. And actually, we saw on Friday that the unemployment rate fell back to its 50-year low. That's the soft landing type of scenario, right? That's the landing where essentially monetary policy tightens enough to bring inflation down, but not enough to push us into a recession. Has your perspective on the possibility of a soft landing changed in the wake of that report? We get a lot of high frequency data on the labor market from a number of private companies. Does your perception of the jobs opening situation change your perception of how we can get to that soft landing?
Well, I had been hopeful that vacancies would come down much quicker than unemployment would go up and things like that. So it's nice to see a little indication of that. But there's long ways to go. Vacancies are still very high, and the labor market is businesses are thinking through the current risks that they face and whether or not they are thinking about cutting back on their staff, or they're just sort of thinking, maybe attrition is going to let this go and things like that. So I think there can be adjustments in other ways as well. I think we're going to do a technology swap here.
Everything's live.
It's sort of easy. We got a dual mandate, maximum employment, price stability. For the longest time, there's been good alignment. When inflation is low, unemployment has been high. So it was clear what monetary policy should do. Now we're in different places, but actually unemployment is low. But I think it's always been, we need to focus on inflation. And when inflation was low, we needed to pay attention. Now inflation is high. And so I think it should be the case that the labor market can be strong and inflation can, be at our target, can come down to our target. I think we're seeing these supply side challenges. We know that demand is outstripping supply because of a number of factors and the constraints on supply. If there's time for the supply side to catch up and improve, then demand doesn't have to be restrained as much, and then we can go off. That's the kind of scenario that I have in mind, that I'm looking for. And I have to be mindful of the fact that that's a pretty narrow path. And so it might not work out that way, and we have to be in tune with that. So again, I think that the front loading that we have exhibited with monetary policy has been useful for getting off the effective lower bound, getting to something closer to a restrictive, certainly it's restrictive now, but the restrictive position that we need to be, so that hopefully we can get to the point where we're able to monitor the developments in the economy without moving ever at each meeting to more restrictiveness in a big way.
And I mean, last year, you mentioned this in your speech, but last year we were using the naughty word, transitory, when describing the inflation outlook. If you reflect back on the past year and everything that we've learned over the past year in terms of the inflationary dynamics, where do you consider inflation to be going into next year? And how do you perceive the risks around that forecast?
Well, I mean, we're looking for inflation to come down, and certainly transitory was a characterization of inflation that, you know, did not serve us very well. I don't think permanent was the right way to describe those inflationary pressures. And so something that's non-permanent is what we were trying to get at. Persistent. It's been much more persistent than I thought. So, you know, when we were focused on the semiconductor, you know, shortages, the fact that, you know, factories in Malaysia and Indonesia and other places were closed down because of their COVID policies. And you kind of go, well, if they could solve that and they get the backlog, that would be helpful. You could kind of see how relative price increases could be coming down once supply adjusted, but it's persisted. It's sort of spread out into more goods that are being produced. The overall demand for goods has just been ferocious relative to services, and that's persisted, and it's worked its way into broader measures of inflation. And so it certainly has persistence. I think that monetary policy will be able to, you know, get that out of the inflationary process, so that we'll be coming down. But anybody who has a forecast for inflation coming down that doesn't have the so-called unemployment rate just, you know, cratering up to 5 and higher has in mind something like improvements in supply chains. It's a question of how much, how quickly, and how that affects the policy trajectory.
And on that very point, I mean, there's a lot of talk of persistence and breadth in inflation, but how do you perceive the downside risk to inflation? We've seen shipping costs fall quite sharply. We've seen some retail goods. We've seen some used car prices starting to fall quite significantly. Housing prices are also starting to correct. Do you perceive any downside risk to inflation, especially if we were to be in a recessionary environment in a year's time?
Well, we need elements of those features to find their way into inflation. And so, you know, first thing is when inflation is high, we need some of that disinflationary wave to average out some other things. The other thing is, you know, sort of the corollary to, you know, being beat over the head for saying things are transitory is going to be, well, when these things start coming down and you're round tripping and it's, oh, well, we all knew that those things were coming down, right? Those are base effects and whatnot. And it's the underlying, you know, persistent part of inflation that you need to be worried about. I mean, you know, everybody wants to have things, you know, exactly the way that they want it. But that's true. I mean, we're seeing this in shelter. It's going to take a while, in part because of the way the data gets reported, I suppose. And households are worried about inflation. They're experiencing high inflation. You know, we're very fortunate that we're not in Europe, that we're not experiencing the increase in natural gas prices that the UK is facing, 7 times the normal price. When gas prices go up in the US by you know, a fraction of that amount, there's a really bad consumer reaction to that. Rightly so, I understand that. So there's a lot going on. It will be important for us to see some of these disinflationary forces. While we're just averaging still above 2%, we need to get down to 2%. It'll be a while, I think, before a low interest rate, low R-star environment reemerges. It may not emerge. I'm a little worried that it will, and then we could end up with a sub 2% inflation concern. Years ahead, not now.
Yeah. And you mentioned during your speech that you still anticipate that the Fed funds rate would be somewhere above 4.5% by early next year. Does any of the recent data in terms of evidence of an increasing slowdown in private sector activity lead you to reconsider the trajectory, especially another 125 basis points by the end of the year, which would entail likely another unusually high rate increase of 75 basis points in November and 50 in December?
I think the labor data has been interesting, that it, you know, continues to be strong, even though it, you know, it's coming down. So, you know, like I say, I think that's a good thing because businesses need workers. They just need them in the right places. And so that's going to be a challenge. We need to see inflation coming down. We need to have confidence that inflation is coming down. Unfortunately, We have had a run of bad luck where we kind of thought, well, first off, we thought it would be transitory, and then it wasn't transitory. Then we thought that, in the summer, we got a good inflation report, and we thought maybe that was indicative of some of the turnarounds that we were expecting to see. And then we've gotten bad inflation reports since then. So it's just much more persistent than we thought. If we have ever said we needed clear and convincing evidence that inflation is coming down, the clock is still waiting to start on that, unfortunately. There's not a lot of difference in so many policy proposals, 75, 50. When you look at the SEPs, the endpoint for everybody in the most recent, submission, virtually, there was quite a clustering, is, 4.5, 4.75. Get to a point, does it matter if you get there in December versus March or April? I think markets are all over this, and I think that it's sort of 20th century monetary policy that thinks that I got to have the setting exactly right today to do this versus 21st century monetary policy. It knows that market expectations and everything we talk about is going to be important for getting the restrictiveness in place. And so I don't think there's a lot of difference, but getting to a position where we explain carefully, we're at a restrictive level and we think that now we can monitor the data as it comes in. I think that's important. That's my viewpoint. And we know that we're going to need months and months of data to see things coming down to convince us that this is better. As inflation goes down, sitting at a particular nominal funds rate will be more restrictive because the real rate will continue to increase. And so that will also be helpful for us ultimately getting to a point where it's like, yep, we've got enough restrictiveness in place. Yep, we see things coming down. Yes, it's time to adjust, but we need to be data dependent. We need to, be able to have the time to look at that. And that's kind of a challenge at the moment. It seems to me. Or it will be soon.
Yeah, but with regards to that very point of lags in terms of monetary policy affecting the economy and the fact that financial conditions have gone from the loosest they were on record at the start of the year to near the tightest they've been outside of recessions, does it not worry you that there's a risk of overdoing it in that very data dependent approach, given the lags?
Well, the way I described it was I want to get to a level that I think is restrictive enough to have a good chance of bringing inflation down, but not so restrictive that it's looking to generate a recession. I don't see the need, ex ante to have that belief to bring inflation down. I think there's still enough supply chain issues that can be resolved that will, solve that. So the way I articulated it, tried to in the speech, and what I've been saying here, I think is consistent with trying to get to a point where we can do that without it being too restrictive. But, if we, start having certain dates in mind where things have to be done quickly and then you get a bad report, have you set everybody up for, yes, but I kind of thought that this would be setting a policy that would be able to withstand one or two bad reports. That's a tricky issue, and given the bad luck that we've had, I think that that makes me nervous. And so that's why being able to get to a point, confidently explain it, or if you could stretch it out, it has value. But the committee is very clear in the way that we're clustered around early next year, getting to that 4.5-ish range.
And broadening out the debate in terms of policymaking to a more global framework, we are in this unusual, globally synchronized but uncoordinated tightening of monetary policy around the world. And I believe many policymakers have said that there's a real risk that in this very rapid tightening cycle globally, there could be the risk of overdoing it, not just on the US front, but globally with the ECB, the Bank of England, the Bank of the Bank of Canada, all the central banks tightening at the same time. How do you perceive that risk? I'm not going to ask you about the dollar because that's not your remit, but how do you perceive the risk of this globally synchronized but uncoordinated tightening cycle?
Certainly, there are regional differences in the risks that everyone's facing. You've got, the catastrophic Russian invasion of Ukraine and its implications for Europe. You've got the implications of reduced energy supply to Europe, the technology to, ship gas liquefied to Europe. That there's not a supply chain that does that easily or at scale or something like that. So those are real challenges. The risk of a downturn in Europe is, quite strong. How does that affect the global economy? You've got, the Asian situation in China and their response to COVID and how that affects our supply chains. And so that's not helpful for the risks that, we want to see supply chains improve so that inflation's coming down. That's the US situation and globally as well. So those are all important. We're all facing many similar issues. This wasn't just, 3 fiscal increases in support for US households and businesses in the US that was overstressing capacity. I mean, inflation is high worldwide. So this supply channel issue is of first order importance. And then on top of that, we've had strong demand. So we have to address it in the US. Everybody is focused on, inflation is running at 10% in so many countries, right? So you just know that you need to get policy into the right place, at least restrictive, so that you're not accommodating that. And then every central bank makes a separate judgment as to how much they're willing to risk.
Great.
And credibility is really important in so many places, everywhere, but yeah.
All right, well, I'd spend the entire day asking you questions, but unfortunately we've run out of time. So thank you very much for your time.
Thank you.
Yeah, on to the next episode. Thanks.
Thanks.